Hi, thank you all for joining us for Valley View's Foundation's first ever educational webinar. My name is Julie Kaufman, and I'm the Executive Director at Valley View Foundation. Our mission at the Foundation is to support the extraordinary Valley View healthcare network that we're lucky enough to rely on here in our region. Recent federal legislation has precipitated some changes to tax law, and some of these will impact charitable giving and charitable giving vehicles. Valley View is fortunate to have expert advisors from Northern Trust to help us understand these changes. Jane Ditelberg, Director of Tax Planning, and Elizabeth Mack, Senior Relationship Advisor, will educate us about these impacts. And just a housekeeping note as we get started. Feel free to include any questions that you might have as our presenters go in the Q&A chat. Speakers will answer relevant questions throughout, and if they do not get to your particular question within the presentation, we will save some time for Q&A at the end. So it's my pleasure to introduce Jane and Elizabeth.
Thank you so much, Julie. We are excited to be here today and to walk through the recent tax legislation and what it means as you're contemplating charitable giving. There were a number of changes, and some are not related to charitable giving, but we thought we could talk through a few things as they relate to how the changes fit into your planning. So a quick introductory point, the One Big Beautiful Bill, as it was called prior to enactment, was enacted in July and is now the One Big Beautiful Bill Act. So that's a mouthful. It is referred to as a number of acronyms, a number of different names, but for purposes of today's discussion, we will refer to it as OBA. And most of the provisions under the bill take effect after, the act, take effect after December of this year. So they won't actually start until 2026. But with the changes taking effect in 2026, there are a number of practical considerations as you all, as donors and contemplating charitable gifts, decide what to give in 2025 versus what to give in 2026 and beyond, and how it all fits together. So we'll provide some examples along the way. So hopefully the discussion is helpful. As mentioned, if there are questions, put them into the Q&A and we will address them. And then we do have some time at the end as well. So as Julie mentioned, my name is Elizabeth Mack. I am here in Denver, in the Denver office of Northern Trust, work with families and clients throughout the Rocky Mountain region. And I am thrilled to be joined by Jane Ditelberg, our National Director of Tax Planning. She does an amazing job of distilling a lot of frequently very dense tax legislation and tax language for all of us. And we get to share her insights with all of you today. So Jane, we're going to walk through some of the ways the changes under OBA might affect an individual's charitable planning. Can you highlight for us kind of big picture a few of the points that are most related to charitable giving, and then we will dig into some details and some examples.
Of course, and thank you both for your kind introductions. I'm very happy to be here. I'm from Chicago, and I can say that apparently we have less snow in the forecast than you do right now. So looking at this slide, the changes that are made by the One Big Beautiful Bill Act, or OBA, include two provisions that are going to reduce the amount of your deduction for charitable contributions beginning in 2026. And we're going to go into the details on those limitations shortly. But there are two planning points that come out of that. First, if you are thinking about making a gift and not sure if you're going to make it this year or next year, you're going to you'll get more tax benefit if you can accelerate it into 2025. That's because these new rules don't go into effect until 2026. The other thing that you'll want to keep in mind is that qualified charitable distributions from retirement accounts, which have always been a good way of making charitable donations for those who are over 70 and a half, are going to be an even better option in 2026 and beyond because they're not implicated by these new deduction limitations. And that's because a QCD is results in an exclusion from income rather than a deduction. So we'll go through an example later, but again, if you are over 70 and a half, it can be your own IRA or an inherited IRA. And even, 70 and a half is younger than the required beginning date for many IRA owners. You don't have to be in pay status or have a required minimum distribution in order to make a QCD, but it will count as part of your RMD or all of it if you want. There's a $108,000 limit this year, and I know in one of the slides it says next year it's 115. We were estimating that, and we actually got the number from IRS, and 2026 the number is 111,000. So those are that's another thing you're going to want to think about besides accelerating gifts. There's also, when we talk about these new rules, they're going to apply for people who itemize their deductions. If you are someone who takes the standard deduction, and the standard deduction has been going up quite significantly since 2017, you may not itemize your deductions. And if that's the case, you're not getting any charitable deduction now. Beginning in 2026, there's a new charitable deduction for non-itemizers. It's $1,000 for a single taxpayer, $2,000 for married filing jointly. This is not subject to the limits we're going to talk about for other deductions. So this is a useful thing for people who have been taking the standard deductions. There's also a new tax credit for contributions to scholarship funds that you may have heard about. And the main thing I'd like to let you know about that is that it doesn't come into effect until 2027. So if you were thinking about allocating some of your charitable giving to scholarship funds, you may want to wait on that.
Great. Thank you.
Sure.
That's a helpful overview. So I think let's dive into it in a little more detail. You mentioned in your overview this concept of the ceiling and the floor when it comes to the charitable deduction limitations. Can you walk through how this applies to donors and what they might want to think about when it comes to their charitable giving?
Sure. So there's two different rules that are going to impact the amount of the charitable contribution that you're allowed to deduct. And what that does is it reduces the tax benefit of your charitable contribution. One of these rules gets referred to the floor, and that rule says that the first 0.5% of your adjusted gross incomes, that amount of charitable donations are not deductible. And that's for everybody, no matter what tax bracket, and it only applies to charitable deductions. We're going to talk a little bit later about how that works if you have a trust, but for individuals, amounts under that floor are not deductible. In addition, you'll hear talk about the ceiling. And the ceiling says that if you are in the top income tax bracket, the 37% income tax bracket, that starts around $630,000 next year for single and around $730-ish for married filing jointly. If your income is at those levels, you're going to lose the benefit of 2% of your all of your itemized deductions. What they do is take the amount of your deductions or the amount of your income taxed at 37%, and it reduces the tax benefit of your deductions by 2%. It's by amount equal to 2 divided by 37, and what that's doing is it's the policy behind it is to let you get the benefit as if you were in the third of the deduction, as if you were in the 35% bracket instead of the 37% bracket. Now, there's one big caveat on that, and that is that many people who have income over the threshold, have AGI, do not actually pay 37% because some of theirs, for example, might be long-term capital gains. So there have been some calls upon the IRS to issue regulations that will clarify exactly how that applies. But assuming that all of the income, and based on what we're reading right now, the threshold is the threshold for the beginning of the 37% bracket, even though you might not be paying 37% on all of that income.
Got it. Thank you. So it's kind of that concept of the ceiling and the floor is helpful, I think, in looking at that illustration and kind of what falls into that category with these changes. A lot of folks might have also heard the expression a shave and a haircut for the charitable deduction limitations. Can you explain that a little further and just how that fits into the ceiling and floor concept as we're walking through these examples?
Sure. I really like this analogy because it's a little more descriptive of what happens. The shave is the 0.5% floor. And what it provides is that there's no deduction for charitable gifts that fall in that category. So what it does is it shaves it completely off. And it's at the bottom of the face. The haircut, it doesn't cut all of the deductions off. It just reduces their benefit. So it's like getting a trim on the top. So that's kind of why some people may find the shave and a haircut imagery more descriptive than the ceiling and the floor. It's complex stuff, so we're trying to explain it in as many different ways as we can.
That's helpful. And I think anytime we're trying to convey some of the details around tax language and legislation, pictures help, right? So I think these help a lot too. So why don't we walk through an example, because I think examples also really help when we're looking at the impacts of these limits on deductions for an individual who might be considering giving this year.
Sure. So we're going to compare two people who might give a gift in 2026. And they're both contemplating a $200,000 gift, and they each have $40,000 in state and local taxes. And note that in order for, we're assuming that that's because they live in California where the tax rates are high, but it could be, depending on their situation, they could really live anywhere that they have a significant tax burden. So they're both single. Ed has income each year of $500,000. Ted has income of $2 million. And so we're going to look at how having income in a different bands, one that's lower than the 37% bracket and one that's higher, and how this impacts the charitable gifts next year. The thing to remember is that the charitable gifts this year are not going to be reduced at all. So if you make a $200,000 charitable gift this year, you're going to get $200,000 in deductions. And you'll get some amount of deduction for your SALT cap as well, state and local income taxes. But next year, all of this could be work a little differently. So let's look first at Ed. He has $240,000 of things he paid that would be deductible. Now, because he has he has $500,000 or less in income, he gets the full he gets to take his full $40,000 in state and local taxes as a deduction. He does not have it phased out. Now, the charitable contribution floor applies to him as well as to everybody. So that's going to take out $2,500 of his charitable contribution is not going to be deductible. So that means now there's no limit, there's no ceiling applying here. There's no haircut because he's not in the 37% bracket. So the total reduction of his charitable donation is the $2,500. He's going to be able to deduct $237,500, and he's going to get $83,125 in tax benefit from his deductions. Now, Ted, on the other hand, has $2 million in income. He has the same $240,000 in itemized deductions. He's going to have his state and local income tax deduction capped at $10,000 because his income is over the $500,000 threshold. The floor, which is based on his higher income, for him is $10,000. So even though the charitable contribution that both Ed and Ted have is the same, the $200,000 gift, Ted's charitable contribution reduction is $10,000, and Ed's is only $2,500. In addition, Ted is in the 37% bracket, so he's going to have the ceiling apply as well, and that's going to deny a deduction for another $18,810. So his itemized deductions, they've both started with $240,000, but he's only going to be able to deduct $188,190, and the tax benefit's going to be $69,000 instead of $83,000. So as you can see, both moving from 2025 to 2026, that's going to reduce your deductions. In Ted's case, he would lose they would both only get $10,000 of SALT deduction in 2025, but the other reductions would not impact them this year. And next year, there's this interplay between how much income you have and how many deductions you have. So it doesn't hit everybody the same way. So we hope that this is kind of helpful in understanding just how these are going to impact. Now, one of these things that it points out is that it's important to manage your income to stay in a lower bracket in the year that you make a significant charitable donation. And you might do that by harvesting some losses, by deferred compensation, or potentially by focusing on non-dividend paying stocks and tax-exempt income, or you might, so when you're planning a big deduction in 2026 and beyond, you're going to want to, see if you can do it when your income is the lowest it will be. And in addition, it may mean that you want to make a large gift every couple of years instead of one gift a smaller gift every year. That's a technique we call bunching. And the reason for that is instead of getting, let's say you're Ed, instead of getting $2,500 cut off the bottom of the charitable contribution every year, you would get $2,500 cut off the bottom once, whether you make a gift of $10,000 or $10 million, it's still going to be the same charitable contribution floor. So some people may be better off trying to not make a big, not make the smaller donations over multiple years, but to use a single year.
It's a good point. And I know we're going to come back to some examples of accelerating and of bunching gifts. So we will get into that into more detail. And I think this example helps to illustrate, Jane, as you mentioned, the income tax bracket management, which is going to be key, excuse me, going forward. But also some of the other provisions that were adjusted or changed under the legislation, for example, the state and local tax deductions that fit into the bigger picture, even though we're not going into as much detail on some of those provisions today. So I do think it would be helpful. You mentioned in your overview QCDs from retirement accounts, so those qualified charitable distributions, which can be made directly from an IRA as part of your required minimum distribution, and can be a tax efficient way to get gifts to charities. And the amount that that can be used for QCDs, Jane, as you mentioned, is going up slightly next year. It's gone up a little bit the last couple of years after remaining pretty steady for a long time. But one thing, again, to consider is that the floor and ceiling restrictions that we have been discussing do not apply to qualified charitable distributions to these QCDs. So Jane, could you walk us through a quick example of giving with your QCDs, a lot of acronyms, your QCDs from an IRA, using your RMD, so that we can see what that looks like as individuals are contemplating, again, the giving amount and timeline.
Sure. So in this example, we have a single taxpayer with $800,000 of other income and no itemized deductions for this purpose. So this is not a terribly realistic, but it's just trying to focus on the impact of this particular decision. The column on the left is if you have a $100,000 RMD and you do a QCD. And what that does is you have previously you have $800,000 of non-IRA income. You don't take that $100,000 into income. The charity gets $100,000. There's no reductions, and your overall tax is $253,000. In the right-hand column, we illustrate if the person had $800,000 of non-IRA income. They took their $100,000 RMD, so now they've got $900,000 in taxable income. They give $100,000 to the charity, but their deduction is reduced to $90,595 because there's a floor and a ceiling, and so the overall tax is $256,500. So we've got more tax due, fewer deductions. So this is a bigger disparity in the benefit of a QCD versus taking the RMD and then making a gift beginning in 2026 because of the application of the ceiling and the floor.
That's helpful. Not to mention it doesn't pass through you for income tax purposes and can be beneficial for a number of reasons. So,
right. One of the big ones is there's all these deductions that are now tied to how much income you make. And there's already things that are tied to how much income you have, like your Medicare premiums. So when you do a QCD, instead of pulling out an RMD, you end up with, you don't take those amounts into income, and therefore it doesn't impact your eligibility for those other deductions or how much your Medicare premiums are, et cetera.
Right. Good point. So let's come back to the idea of accelerating gifts into 2025. Well, let's look at an example using a donor-advised fund. So if a donor-advised fund is either going to be established or additional funds are going into a donor-advised fund, do these changes mean there may be reasons to accelerate gifts maybe this year, rather than waiting until 2026 or later?
Right. Well, the main thing, and this applies to gifts to DAFs or not DAFs, but the reason I like to explain it with the DAF is, let's say I'm somebody who generally makes $100,000 of annual charitable contributions. I'm not exactly sure the combination or how much I would give to each charity, or maybe even which charities would get some. But I would like to, accelerate it into 2025. So instead of giving $100,000 a year and being impacted by the floor and the ceiling, I give $400,000 to the DAF in 2025, and therefore I get to deduct the whole $400,000 instead of having my deductions reduced to $373,144. You can have the same outcome of $100,000 going out to charity each year, but you do it by putting it in the DAF and then having it distributed from the DAF when you decide what you want the gift to be. So that can be a helpful way to accelerate, and you get a there's a $10,000, roughly $9,937 tax difference. So it does add up to real dollars in your pocket.
It does. And I am curious how this might affect or be considered for individuals who might already have multi-year pledges in place. Can you speak to that a little bit as well?
Sure. Another, one set of gifts to consider accelerating is if you have a multi-year pledge out there. So in this one, each of Grant and Lily has decided to give $200,000 to a local hospital between 2025 and 2028, and they each have income of $1 million. Grant makes 4 separate annual gifts of $50,000, whereas Lily makes a $200,000 gift in 2025 to satisfy her entire pledge. This particular table shows the tax benefit, not the amount of tax or the amount of the deduction. But what it shows is that Grant's tax benefit is 9% lower than Lily's for the same amount of charitable contributions. And that's because, as you can see, in 2025, he gets $18,500 of tax benefit for his $50,000 contribution. But that's reduced to $15,750 in 2026 and following years. So it's that reduction in the tax benefit for your charitable contributions that we're trying to avoid by accelerating the full gift of $200,000 into 2025.
Thank you. I think that, again, just charts and illustrations are helpful as we're talking through these concepts.
Sure.
So moving to another chart. So a lot of the families that we work with, and I'm sure a lot of the families that contribute who are on the call, either have or from time to time consider implementing split interest trusts. So the charitable remainder trusts, or CRTs as they are commonly referred to, that benefit individuals first and then the remainder goes to a charity, or the flip, the charitable lead trust, or CLTs, that are going to benefit a charity or multiple charities during the term of the trust, and then individuals after that term runs out. So the version of these trusts that I think is helpful to talk through, especially our charitable lead trusts, and how they are impacted by the changes under OBA as well. So can you talk through this example, especially given the concept of the floor and how it impacts the charitable lead trust structure?
Of course. Charitable lead trusts can be structured 2 different ways. One is, and when they're done during life, it's different at death, but we're talking here about lifetime charitable lead trusts. They can be a grantor trust where the donor gets an upfront charitable deduction for the present interest of what will go to charity ultimately. And then there are no other deductions, and the grantor pays the income tax on items of income earned by the trust. The alternative is for the trust to be a non-grantor trust. And for a non-grantor trust, there is no charitable contribution deduction up front, but the trust gets to take a charitable deduction for each distribution it makes to charity. What happens under OBA, first of all, when we look at Mike, who's using a grantor trust, is that if he makes it in 2025, he gets a bigger deduction than if he does it in 2026. His deduction goes from 870 to 814. So it makes a difference when the timing is, and that difference is going to matter for a grantor trust approach. The other thing is that because the non-grantor trust is a trust, and the way that charitable deductions are computed for trusts is different, non-grantor trusts are not subject to the 0.5% floor. And that means while Jessica's trust's deductions are reduced by the ceiling, they're not impacted by the floor. And so when you look at this, and because the deductions all come after 2026, because the charitable lead is when you make the payment, based on when you make the payment, not when you make the gift up front. But either way, hers are the same, whether she does it in 2025 or 2026. But her deductions are more than Mike's. And so that's just something to keep in mind. It's not going to be the driving factor always, because sometimes, the reason you want it to be a grantor trust is that you need the deduction in 1 year because that's a year you sell your business or something. So that you got to run the numbers, but there's a new factor to think about when you're choosing.
Yes, thank you. I think that's helpful. And split interest trusts are a little bit more of a complex giving vehicle than outright gifts or DAFs or some of the other items we've been discussing. But for example, in the year of a liquidity event or a significant planning opportunity, they could prove to be very helpful. Just a little more complex to implement and analyze. So I think that's a helpful example as well. So we talked about accelerating gifts. Let's talk about bunching gifts, and especially where we are looking at that standard deduction. And since OBA raised the standard deduction and more people are likely to take it, can you walk through what bunching gifts sooner might look like for a taxpayer who is taking that standard deduction?
Sure. So one of the things that happens when you take the standard deduction, and lots of people take the standard deduction, it's not just people with low incomes. I was talking to a person with, $7 million of annual income who only really qualified to take the standard deduction because of they were doing their charitable giving through QCDs and through an already existing DAF, and they weren't able to deduct any real estate taxes, and they didn't really have any other deductions. When that happens, you don't get any benefit from your charitable contributions. I had this conversation with my husband last year and tried to explain this to him. But if you bunch all of your gifts into 1 year, you get a couple of different benefits. First of all, you're not going to take the standard deduction in the year that you make the charitable gifts. You're going to have enough charitable gifts that you'll get a bigger deduction and than the standard deduction. So you're going to, in that year, get a bigger deduction than you would have. And in the subsequent years, when you're now not making those charitable gifts, you're still going to get the charitable deduction. So you're still going to get the standard deduction, which is what you were going to get anyway. So this is a way to get some benefit from your charitable gifts if you're taking the standard deduction. The other thing is that beginning next year, you can take a $2,000 $1,000 for single, $2,000 for married, additional deduction if you take for charitable contributions if you take the standard deduction, and that's not subject to the floor or the ceiling. So if you bunch most of your gifts into 2025, but you do make some smaller ones in the subsequent years, you should still be able to get that other additional deduction. The other thing is with the floor. Once you get over the floor, you might as well make as many gifts as you can. That 0.5% floor, if it's applying to you, rather than have the 0.5% taken off every year, because it's based on your income, so it doesn't matter how many charitable gifts you make in a year, you're still going to have the same reduction for the floor. So this is a reason we talk about bunching gifts. And another note I have on this slide is if you make the gifts with appreciated securities, and that can be to a donor advised fund or another charity. It doesn't have to be a donor advised fund. The charitable entity will not recognize the capital gains from that. They won't pay tax on the capital gains of that appreciated security. So it saves you get the income tax deduction, plus you also end up not paying the capital gains than if you sold the asset, paid the capital gains tax, and then donated money to the charity. So that's something helpful to keep in mind as well.
That's a good point, and always something to consider, especially given how much equities have grown over the recent years. Today being a little bit of not growth, but for another day.
Yeah, it's still up for the year.
Yes.
And
yes.
And speaking of this floor and bunching, that's going to apply to corporations as well. There's a new OBA introduced a new 1% corporate charitable deduction floor beginning in 2026. So corporate giving is going to be impacted the same way. Corporations will also, for that reason, want to consider bundling it into fewer years rather than spreading them out. And one interesting piece of advice I've heard some other advisors giving is that some companies are rethinking whether items that they previously deducted as charitable contributions will fit into some other business expense category, such as advertising. So, for example, if you pay for Little League uniforms that have your business's name on them, is that a charitable contribution, or is that an advertising expense? So people may want to be rethinking some of those things for corporate donations.
That's a good point. And I know, did you want to mention just quickly for anyone who might be wishing to support higher education or scholarship funds?
Sure. So we mentioned before that there's a new kind of scholarship fund that can receive donations and get a tax credit, which is always more beneficial than a tax deduction because it's a dollar for dollar reduction in tax. But that doesn't come into play until 2027, and we still have a lot to learn about how that's going to look. We're waiting for regulations. The other thing is that there is a new increase in the endowment tax for private colleges and universities that are larger. There's an exemption for if you're under 3,000 students. So we're talking about large private charitable or educational institutions. They are going to pay a higher tax on assets they keep in their endowment. So this may impact donors who may want to consider gifts that are not going to get stuck in an endowment and be subject to that tax. And that may be using a DAF, which will make annual distributions to the charity, which they can then spend, making the annual gifts to the charity yourself so they can spend it. Or they may want to reconsider whether their charitable objectives can be met by making a gift to a different charitable organization. Sometimes it's a related charitable organization. So, for example, sometimes there's really fine lines between medical schools and hospitals, for example. So we just want people to be aware of it. It's not a it's not a big change for a lot of people, but it's just something we wanted to make sure we covered.
Yeah. Thank you. A lot to think about.
Yes.
As people are contemplating gifts this year and in the future. So I did want to just come back to, I know we summarized things a little bit at the beginning, and now we have the kind of key takeaways at the end. Did you want to comment just quickly, Jane, for kind of what the key takeaways are that you want to be sure to highlight and that people maybe jot notes down on today?
Sure. What we're really suggesting is you want to consider accelerating large charitable gifts into 2025. And remember, you have to get that money to the charity or at least mail the check by December 31st, 2025. And this may include revisiting any outstanding pledges you have as to whether you want to accelerate them. We want to remember that qualified charitable distributions from IRAs are the most tax efficient way to make charitable gifts for those over 70 and a half who have an IRA. And we want to just remember this year and next year and beyond, when you're making charitable gifts, that you're going to want to use bracket management and bunching to maximize the benefit of the donations that you do make.
Thank you. And another point is, I was going to say, it's just involving outside advisors, making sure that when you're evaluating some of these tools and strategies, just to run the numbers for your actual scenario to make sure that that the chosen structure works for you. But if you are interested in talking through things further or have specific questions, Jane and I are certainly available and happy to walk through things. So we do have one question in the queue, and if anyone has other questions, please feel free to add those, again, using that Q&A button on the Zoom screen. But the question that we got that came through is, does the scholarship fund change only apply to higher ed institutions, or would it also impact a nonprofit, for example, who offers a scholarship for their program fees?
It's not going to apply to either of those. This is going to apply to very specific scholarship funds created in states and approved by state government for elementary and high school, private elementary and high school education. So it's not going to affect things that aren't private elementary or high school. It's a $1,700 credit, but there may be other limits on it. And you may have, none of the states have adopted anything yet. And there's no obligation that your state do adopt it. And I think this is going to come into there's a lot of politics that are going to come in at the state level, I think, before we see what these are going to look like.
And as you said, there's a couple years to learn more here.
So we have one about, does making QCDs greater than the RMDs up to the annual QCD limit still reduce AGI? So yeah, if let's say your RMD is 20,000 and you can still make the 108,000 and exclude that from income, and that will reduce your subsequent QCDs. So we have answered those two. Yeah. Anything else? I'm sorry if we've stunned you all into silence. I know this stuff is complicated, but we're very friendly. We don't bite, and we're happy to answer any questions that you might have.
Yeah, thank you so much, Jane and Elizabeth. Obviously, if you would like to talk to me or either of these expert advisors, I can connect you. There's so much I've learned here today. Obviously, these impacts on charitable giving are really important for donors. They're also really important for charities to understand. So, I know there are some nonprofit professionals on the phone with us today or on Zoom with us today, and really understanding your donors' goals, especially at these higher income levels, is super important, right? If
Yeah.
someone's bunching gifts and you're getting something bigger this year, it might be a good idea to pick up the phone and just say, hey, are you bunching this gift? Do we need to sort of time restrict this? Or, can we rely on your annual support? So I think there's a lot of lessons to be learned on the charity side too. So really, really appreciate your time today.
Thanks. I have one more point, and I guess because we were going fast, I think it's on one of the slides. But the $1,000 deduction for non-itemizers only applies to cash gifts to public charities and not DAFs. So this is just like the one we had during COVID, which allowed $300 of deduction for non-itemizers for cash gifts like this. So it's the same rules that apply. They've just upped the amount.
Good point.
It's been a
Excellent.
pleasure to be here with you.
Yes. Thank you, Julie, for inviting us. And Jane, thank you for sharing all of your insight. We're happy to answer other questions. You can reach out to Julie to reach us, and hope this was helpful.
Yeah, thank you so much. Anyone who's on this Zoom will also get the recording. Feel free to share it far and wide to anyone who might be interested. And I hope everyone enjoys the rest of their day.
Take care.
Thank you.
Great. Thanks. Take care.
Bye-bye.